Now let us move to reading 43 of portfolio management with portfolio risk and return. Here we'll look at various measures of return, the characteristics of major asset classes, the concepts of mean, variance and covariance, which will be forming the mathematical basis of portfolio management. Then we'll look at the risk aversion, then the idea of standard deviation of the portfolio, the correlation among assets or among securities and risk reduction, minimum variance and efficient frontier of risky assets, and global minimum variance. And finally, the capital allocation line. Let us start with return measures. One of the most popular and the basic measure is holding period return. So if an investor has been holding an asset for a given period, this reflects the overall gain for that period. It is not adjusted for a specific time such as annual or semi-annual. This is unadjusted return for holding period. And the formula is given by end of period value divided by beginning period value minus 1. This is the price at time t. We deduct the dividend to adjust for the value which has been given in this period. P0 is the initial price. Or the same thing can be represented in this way. Pt minus P0 is change in price, or we can also say this is capital gain, or we can also say it is capital gain while this is dividend given in this period. Let me explain with the help of an example. If the stock price was $30 in the beginning and it pays $2 in dividends over the period, and $35 is the price at the end of the holding period, then holding period return can be calculated as 35 minus 30. This 5 rupees is our capital gain, the appreciation in the value of stock. 2 rupees is the dividend gain. 30 was the initial price. So overall we have gained $7. We had invested $30. So this percentage is our holding period return, which is 23.33%. Now let us look at some other simple measures for the return. These are two simple average returns. One is arithmetic mean, another is geometric mean. So if the returns for different periods are given, either we can take the arithmetic mean of that or geometric mean, which is taken as 1 plus r1 into 1 plus r2 and nth root of the equation. We have to subtract minus 1 here. Generally, the geometric mean is preferred because it is based on compound annual rate. The value of geometric mean is always less than arithmetic mean. Let me take an example. Say the return for the first year was 6% and for the next year, say it is 8%. So average return for this 2-year period based on arithmetic mean return will be 6 plus 8 divided by 2, that is 7%. But if we calculate geometric mean, return, that would be 1.06 into 1.08 minus 1 and the square root of this. If we look closely, this is nothing but the compounding. Let me take an example. Say for the first year, the return was 4.5%. For the second year, the return was say 2%. This is first year, this is second year. If you want to calculate the average return annually, the first method is arithmetic mean return, which would be 4.5% plus 2% divided by 2, which will come out 3.25%. If we calculate the geometric mean return, be 1.045 into 1.02 square root minus 1, which will come out to be 3.24%. As we notice, this is less than the arithmetic return. One common mistake which should be avoided is using geometric mean return as square root of 4.5 and 2, which is 3%. This is wrong. So we should take returns in terms of 1 plus R1, 1 plus R2 and so on. Now let us look at one other common method of measuring the return, which is money weighted rate of return. We have already used it in corporate finance. This is same as the IRR measure. The only thing which we need to be careful about is the sign. The initial deposit and the additional deposits are the inflows to the account and are taken as positive, and withdrawal of cash, interest or dividend is taken as outflow from the account and taken as negative. Based on these conventions, we can put these values in the formula, and same as IRR calculation, we can find out money weighted average return. Let me explain with the help of this example. An investor buys a stock for $90 in the starting of the period t equal to 0. He buys another stock for $80 at t equal to 1. That is the end of first year. At the end of second year, t equal to 2, he sells both of these shares for $95 each. In addition to that, it is given at the end of each holding period, that is t equal to 1 and t equal to 2, the stock paid $1.50 per share as dividend. So now we need to calculate the money weighted rate of return. So first of all, we need to look what are the values of CF0, CF1 and CF2 in this case, and then we can calculate. So what should be the cash flow at t equal to 0? Since we are buying, so this is initial deposit. This is an inflow, should be taken as positive number. See here, t equal to 0, we are purchasing first stock for $90, it is an inflow. At t equal to 1, we are buying another stock for $80. Again, this is an inflow, positive sign here. At the end of first year, a dividend is also given from the first stock of $1.5. This is a outflow, so negative sign should be given here. So net is the positive sign, which is inflow. So at t equal to 1, CF1 is positive number, which is $78.50. Now let us look at the second time period, t equal to 2 at the end of second year. We have received the dividend from both the stocks of $1.5 each. So it will be $3. Sign is negative since it is an outflow. And we have sold both of the stocks. The price was $95 each. So 95 into 2 is minus 190. Minus sign represents the outflow. So at t equal to 2, second cash flow is an outflow. So negative sign 193. Now we can simply calculate the money weighted rate of return. These are the values we have put here. First cash flow, second cash flow, these two are positive, third is negative. That is why it is on the other side. And we can get the value of IRR, or in this case money weighted rate of return, which is 9.184%. Let us move to the next slide. Once we have decided the type of return measure we are using, we get the value of return. So these are the certain terms of various steps in performance calculation. So the first is gross return. This is the total return on the security portfolio before deducting any fees. There might be fees which are being charged by the advisor, etc. The second is net return. This is after the fees have been deducted. Then third is pre-tax nominal return. This is the return before paying any tax. As for different instruments or different types of incomes, the tax rate will be different. For example, for dividend, for interest, short-term capital gain, or even security transaction tax, all of them are different. So before paying any tax, we have pre-tax nominal return, and then we have after-tax nominal return after considering all the tax liabilities. Then we have real return, where this nominal return is adjusted for the inflation. For example, if we were getting 8% after tax nominal return and the rate of inflation is say 4%, then real rate will be approximately 4%. Finally, we have the leveraged return. This is the return which is earned on the cash investment by an investor. Sometimes the investor has paid, for example, only $20 as margin, while the actual investment was of $100. So the investor has only paid the margin. This was the cash investment, but the actual investment was higher. So due to this leverage, the return on this cash will be higher. For example, the return was 8% on this $100. On $20, it will be higher. 8% is $8 here, and $8 as a percentage of $20 will be 40%, which is 5 times, because of the 5 times leverage here, because margin was only 20%. That is why 5 times leverage was provided. the leverage return will be higher. Let us move to the next slide. Here we are looking at the major characteristics of the asset classes. The characteristics are in terms of expected returns and the risk, which we are measuring in terms of standard deviation. So if we start from the bottom, this is inflation, which is 3%, standard deviation is 4.2%. The least risky asset is treasury bill. So the annual returns are 3.7, standard deviation is 3.1. If we look at the treasury bonds, long term, the expected return increases and the standard deviation is also higher. Similarly for the corporate bonds, higher returns. And if we move to the equity, the large cap, the annual returns are much higher than bonds and even the standard deviation is also higher. And for the small cap, which are even riskier than the large cap equity, the returns are even higher because of the higher risk, 33%. So we clearly see that when the risk is rising, the expected return is also rising. And based on our risk appetite, we will choose the asset class or the combination of the asset class to construct a portfolio. Let us move to the next slide. Let us understand the basic mathematical concepts of portfolio management, which are mean, variance, and covariance. We have already discussed various kinds of mean. Now the variation, which is the square of standard deviation, which can be used to represent risk. We can use either of them. In the formula or variance is this, where RT is the return and mu is the mean return. If we are using the whole population, then we'll use time period in the denominator. If we are using sample mean instead of mu, which was the population mean, if we use the sample mean, then we'll get sample variance, and instead of t we'll use t minus 1. This t minus 1 is used to avoid the underestimation of variance. Since we have lost 1 degree of freedom by estimation of the mean, we are using t minus 1 here. For the sample we use t minus 1, for the population we use t. Now let us look at the variance. Now let us look at the covariance. Covariance basically indicates the direction in which two variables are moving together over time. So the positive covariance means they are moving together in the same direction. In the negative covariance, they are moving together but in opposite direction in a time period. Zero covariance indicate that there is no linear relationship between the two variables. And mathematically, we represent it through this formula. If we notice, the formula is same as the formula of variance. If we make RT1 equal to RT2, we get the same formula as of variance. Since we have two variables here, this is RT1 and RT2. This is covariance. Now let us look at one other important concept, which is correlation. Correlation is nothing but the covariance which is standardized. Since covariance is an absolute value, it does not give us a proper idea whether the two values are varying together with what magnitude. The correlation is a ratio which is bounded by -1 and +1. So this gives us a comparative number. For example, if the value is 0.8, we know they are highly correlated. If it is positive, positively, or if it is negative, then negatively correlated. If it is just 0.1, we know it is not highly correlated. So since it is a ratio, it gives us a benchmark of correlation. So this is standardized by dividing the product of standard deviation of these two securities. So the mathematical formula is covariance divided by product of standard deviation of these two variables. Or in another terms, we can write it in this way. The covariance is product of correlation coefficient and standard deviation of two securities. So this is unitless, which is a ratio, and it gives us a fair idea about the correlation. So again, the positive correlation will be between 0 to +1, and the value of +1 means that they are perfectly positively correlated. They are moving exactly together, and coefficient of -1 means they are perfectly negatively correlated, that they are moving in opposite direction. And if the value of correlation coefficient is 0, that means there is no linear relationship between the returns of two stocks or two variables. Same as in the case of covariance. Now let me take a numerical example for x. Now let me take a numerical example to explain these ideas. There are two stocks and their performance over the period of these 6 years have been given. These are the returns R1, R2. Let us start with calculating the mean, which is just the average of these 6 numbers. The summation is 0.33 divided by 6 is 0.055. Similarly, for the stock 2, the summation of these 6 values is 0.61 divided by 6, which is the average, is 0.1016. This is the mean for the first stock, this is for the second stock. Then for the calculations of variance and covariance, we have the difference of the mean value to the value. This is the measurement of deviation from the mean of stock 1 itself. So in the year 1, the variation was 0.065 from the mean. In the second year, the variation was this negative variation, and so on. Similarly for the stock 2. So these are the variation from their own mean, and this is the product of these deviations. Finally, the summation of this. Now if we have to calculate the variance, we simply square it and take the average and then the square root. And if we have to calculate the covariance, we already have the multiplication. We just take the summation and take the average and square root. Let us look at the calculations. So for the stock 1, this is just the square of all those values, the summation, and we are dividing by 6 minus 1. Since it is a sample variance, we are using t minus 1, not t. So the stock variance for 1 is 0.0608, for 2 is 0.109. And on the similar lines, we can calculate covariance, which is this, the summation of that product divided by again t minus 1 is 0.05. So if we have to calculate the standard deviation, we can easily calculate just the square root of the variation, variance. And finally, we can calculate the correlation coefficient. we have the covariance, we have individual standard deviations. So we can reach 0.6911, which is correlation coefficient. The number is positive. It says both are positively correlated and moving in the same direction. So we can expect that if one is moving positively, the second should also follow. And if one stock is losing, it is more likely that another one will also lose. Let us move to the next slide. We talk about the idea of risk aversion. This is generally assumed that every investor wants to maximize the return for a given level of risk. Risk is nothing but the uncertainty of the future outcome. Generally, investors are risk averse. Nobody wants to take extra risk. If they are taking, they want to be compensated for that. So the more risk averse is the investor, more is the risk premium. This is the usual case. Sometimes if there are certain investors who do not demand a premium for a risk, they are said to be risk neutral. And if they are enjoying risk without any premium, they are risk seekers. Usually the investors are risk averse. So they are seeking a premium for the risk they are taking. Let us move to the next slide. The portfolio standard deviation. Now we study how the risk of two assets interact with each other and how do they impact the variance of the portfolio or the risk of the portfolio. We measure the risk in terms of variance or standard deviation of the portfolio. As we notice from this formula, the sigma 1 square is the variance of first asset. This is for the second asset. This is the covariance between the two assets, and W1 and W2 are the weights of those two assets in a particular portfolio. We already know the formula for correlation coefficient and covariance. From that, the value of covariance can be put in the formula. So it becomes this: correlation coefficient and standard deviation. Now if we want to calculate the standard deviation of the portfolio, we can just take the square root. Yes. This is the square root of the variance. So now let me explain the mechanism of portfolio standard deviation with the help of an example. Let us take there are two companies in the portfolio and the weight is 60% for Reliance and 40% for Jubilant Foodworks. The expected return individually for these stocks is 10% and 15% respectively. Now let us talk about the risk. The standard deviation of their annualized daily returns are 18.2 for Reliance and 27.3 for Jubilant. Now assuming that they are perfectly positively correlated, the correlation coefficient is 1. Let us calculate the portfolio variance. So the value of W1 is 0.6 and W2 is 0.4. So we know the value of variance is summation of W1 square sigma 1 square, W2 square sigma 2 square and 2 times of W1 W2 sigma 1 sigma 2 and rho 1 2, which is correlation coefficient. Similarly it is here. For the simplicity, it has been shown in the matrix form. We have put all the values W1 W2 rho, which is 1, sigma 1 sigma 2, and finally the summation of all these four values will be our portfolio variance. So let us calculate it. The portfolio variance come out to be 476.99 and the standard deviation, which is the square root of variance, is 21.8%. In this example, if we carefully notice, the standard deviation of portfolio is nothing but simple weighted average of the standard deviations. Let us calculate 0.6 into 18.2 plus 0.4 into 27.3. So this comes out to be 21.8%. So why is it coming same? Because this is the specific case where both the assets are perfectly positively correlated and the value of correlation coefficient is 1. In this specific case, the formula simplifies to this value. So in this particular case, the value of standard deviation of the portfolio is the highest possible since they are perfectly positively correlated. So risk is the highest. Let us look at it further. Yes, the greatest portfolio risk will result when the value is +1. And the formula of standard deviation of portfolio will be simplified to simply the weighted average of standard deviations. So we know the lower is the correlation, the greater is the risk reduction. In this case, the correlation was the highest, so risk was the highest, no risk reduction. But in all the cases where the assets are not perfectly positively correlated or the correlation coefficient is less than +1, in all those cases, the standard deviation of the portfolio will be less than weighted average of the standard deviation. Like in all the cases where value of rho is less than 1, the sigma will be less than this weighted average. So this is the highest risk. In all other cases, the risk will be less than this. So that indicates that as long as the correlation coefficient is less than +1 or the assets are not perfectly positively correlated, we will get the benefit of diversification. Let us elaborate it with the help of another example. Suppose there are again two stocks in our portfolio. One is Mahindra and Mahindra, other is TCS, and say the correlation between them is positive 0.2. The expected returns are 10% and 20% respectively, and their standard deviations are 15% and 30%. Now let us look what will be the expected returns and risk of the portfolio. Let us analyze these values of the portfolio, the return and the risk, for various combinations of weights of these two stocks. Let us say in the first case, we are completely invested in the second stock, Mahindra and Mahindra. The portfolio return is 10% and the standard deviation is 15%, which was the case for individual stock. On the other end, if we invest 100% in TCS and none in the Mahindra and Mahindra, the portfolio return is 20%, which was for TCS, and standard deviation is 30%. Now all other cases are the mix of these two. Let us look at the return first. The return is linearly rising the more we are investing in Mahindra and Mahindra. Let us look at the returns first. The returns are linearly rising the more we are investing in TCS. Since its expected return was 20% and it was 10% for Mahindra and Mahindra, naturally the more we invest in TCS, the more will be the expected return. Let us look at the standard deviation, which represents the risk. So this case is interesting. Here, the risk does not increase from 15% to 30% thoroughly, but it falls to 14.4% for this particular weight, and then it rises once again towards this 30%. So for certain combinations, we can have the minimum risk of the portfolio. If we try to represent this with the help of a graph, we will find this. On the y-axis, we have expected return of the portfolio. On the x-axis, we have standard deviation. We can notice that minimum standard deviation is achieved at this particular return. And for this return, we need to have a specific weight of these two assets. So this combination of these two assets here is also called minimum variance portfolio. Since this graph is not linear, we can see an interesting thing in the lower part of the graph. Here, for the same value of risk, we get two returns. One is this, another is here. So obviously we will prefer higher returns at the same risk. So all the values which are below this are inefficient frontier. We will discuss this in detail in subsequent slides. So we have noticed that on particular graph, the individual can change his portfolio according to the risk and return the person needs. And for different values of risk, the person gets different kind of returns. Let us look at the concepts of minimum variance, efficient frontier, and global minimum variance. So the portfolios that have the lowest standard deviation among all portfolios with a given return, they are known as minimum variance portfolios. And the combination of them will make minimum variance frontier. For example, in the graph, this is the minimum variance frontier, this blue line. And the global minimum variance portfolio is the one which is on the leftmost on the risk and return graph, like this point which we talked about. Every risk-averse investor wants maximum return for a given level of risk. This is the definition of risk-averse investor, and he would take risk only if the premium is given to him. So the portfolios that have highest expected return for a given level of risk, they make the efficient frontier. And on this efficient frontier, the portfolio which has the least risk is the global minimum variance portfolio. For example, if we draw, a chart with efficient portfolios where for a given return the risk is minimum or the standard deviation is minimum, the leftmost point will signify the global minimum variance portfolio, and the all other portfolios below that will be inefficient. Only the portfolios lying on this line will be efficient portfolios, since they are providing minimum standard deviation for a given amount of returns. Now let us move to another important concept, which is capital allocation line. The utility function of an investor represents the combination of risk and return. This utility function is the function of both risk and return. From any combination of risk and return, the investor would want maximum utility. Since we already know that a risk-averse investor would like to have maximum return for a given risk and higher premium for higher risk. So an individual investor might want multiple combinations of risk and return which will give the same utility to the investor. So an investor's indifference curve gives us the combination of risk and expected return which gives him the same amount of utility. So that the investor is indifferent. Any combination of risk and return on that plot gives him same utility. So he is indifferent to those portfolios. So the indifference curve is a tool that represents expected return and risk of the investor, which provides him the same utility. This is upward sloping for a risk-averse investor because he will take risk only when the adequate compensation is given for the risk. And for a risk-averse investor, the indifference curve will become steeper because for every unit of higher risk, the risk-averse investor will demand much higher returns. Let us look at the curve. These are the indifference curves. These I1, I2, I3. These are the indifference curves. And if we see one particular curve, it keeps getting steeper. For every extra unit of risk, the premium demanded increases. The graph shows that individual investor will choose indifference curve 1 because it has the least risk for the same amount of return. Let us look at the graph once again. This is the indifference curve 1, this is 2. For same amount of return, the risk is least in I1, more in I2 and highest in I3. So indifference curve I1 will be selected by the investor. Now let us come back to the idea of capital allocation line. So in order to achieve an optimal portfolio, we need to mix a risk-free asset like treasury bond in our portfolio with the riskier assets. This is the formula. We are already aware of it for the return, and this is for the standard deviation. We know that for risk-free asset, suppose the second is the risk-free asset, the standard deviation is 0 for a risk-free asset. So these two terms will become 0. And portfolio standard deviation will be W1 sigma 1 or WA sigma A. That indicates that risk will be only due to the first asset, which is risky asset. So if the weight in the first risky asset is 100%, then standard deviation of portfolio will be standard deviation of the asset. If it is just 50%, then standard deviation of the portfolio will be half of the standard deviation of the first asset, since rest of it is risk-free asset. Let us look at this two fund separation theorem. It says that an investor portfolio is made up of combination of optimal portfolio of risky and risk-free assets. So the line that represent the combination of risk-free assets and risky portfolios with various weights. For example, WA is risk-free, WB is risky. So various combination of them, for example 0%, 100%, 20%, 80%, 40%, 60% and so on. If we combine all these values, we get capital allocation line. So it will represent various combination of risky and risk-free portfolios. So here we reach the end of the topic. Let us look at a few questions. The first question says, for a two-stock portfolio, what is the most preferred correlation coefficient between the two? Since our objective is to minimize the risk of the portfolio, we know the standard deviation of the portfolio is minimum when both the assets are completely negatively correlated. So the correlation coefficient is -1. So C should be the right answer. Let us move to question number 2. It says the variance or the standard deviation is a measure of, the right answer is total risk. A is the right answer. Question number 3. It says security A has expected return of 18% and standard deviation of 40%. For B and C, expected returns are 12% and standard deviation is 20%. If the correlation between the rate of returns for A and B is 0.35 and for A and C is 0.85, then the investor who is already holding A should go for which combination to be better off? So the investor who is holding only A, he will be better off in which combination? By adding C or adding B or none of them? We have already discussed, if the value of correlation coefficient is less than +1, then there will be a reduction in the risk of the portfolio, and the lower is the correlation coefficient, the better it is. So in this case, correlation between rates of return of A and B is 0.35, which is significantly less than 0.85. So it is better to go with B to reduce the risk. So B is the right answer. Now let us move to question number 4. It says, to effectively diversify a portfolio, an investor wants stock with negative correlation coefficient. The effect will be to decrease the standard deviation of the portfolio. So A is the right answer. Let us move to next question. It says, utility curves will be curved, flat or curvilinear for a less risk averse investor. We know for risk averse investor, the indifference curve will be upward sloping and slope will keep rising. For a risk averse investor who wants more premium in return for more risk. But if it is less risk investor, but if it is less risk averse investor, this curve will be flat. So B is the right answer. These are the answers to these questions.